Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. In this video, we're going to do a warm-up for the gain or loss on the disposal of securities to get you ready for 2025 taxes. Your broker will provide you this information on either the Form 1099-B or the Form 1099 Composite. Let's start by looking at some sample 1099s from various brokers. Starting right down here, short-term transactions for which basis is reported to the IRS. Then right here, short-term transactions for covered tax lots. And then finally down here, covered short-term gains or losses on gross proceeds. All of these phrases that we just went over, they all mean the same thing. A covered lot means the broker knows what your basis was in the position and reported that amount to the IRS. Remember that your basis or cost basis is what you originally paid to enter the position. If we take a further look into this 1099 Composite example that I snagged from Fidelity.com, and we take a look down here in these various descriptions, for transactions in the red boxes, the broker is required by law to know your basis and holding period in the positions, meaning they're required to know those things in order to report that information in these red sections. Again, these red sections are the ones that say the basis is reported to the IRS. Now, in the green boxes, technically the broker is not required to know your basis and holding period. However, my opinion is that this information, if it shows up on the 1099, is generally reliable, unless you have a specific reason to believe that it's incorrect. Again, these are the transactions right here where it says basis is not reported to the IRS. And then finally, in the purple box, here the broker has no clue what your basis and holding period were for the positions that you sold. Therefore, if you see this description on your 1099, transactions for which basis is not reported to the IRS and term is unknown, and it will probably say something like unknown right here under the total cost basis section. In that situation, you need to do some digging and documenting into old brokerage statements to find this information. Or it is possible that under audit, the IRS might just say that your basis is 0 and your holding period is short term. This would obviously be the worst outcome right here, because if your basis is 0, then the entire amount of proceeds would be recognized as gain. And then, of course, if you can't prove that it's a long-term transaction and it's adjusted to be treated as short-term, then you would be subject to ordinary income tax rates on that gain instead of the preferential long-term capital gain rates. Now let's make sure we understand what we're looking at in the table above. This is the type of table you will see on the 1099 Composite. We have the total proceeds right here. There's the total cost basis. There's the total market discount on your position, if any. Here's the total wash sales that you may have had on some of these transactions. And then finally, right here, we have the realized gain or loss. Now, I'm going to throw some nice round numbers in here just for simplicity of this calculation. Let's assume we have $10,000 of proceeds on this transaction. The cost basis was $2,600. There was $500 of total market discount, and we had $200 of wash sales. So what amount goes right here for the realized gain or loss? Let's make sure we understand this calculation. Okay, right here, the default formula to determine your gain or loss is as follows. We start with the gross proceeds, in this case $10,000. We subtract off the basis, in this case $2,600. We subtract off the market discount, in this case $500. We add back the amount of the wash sale, in this case $200. And the result of that calculation is the capital gain, in this case $7,100. So that is what I would expect to see right here on Schedule D. There's the $10,000 of proceeds. There's the $2,600 basis. Right here, this minus $300 is going to be the net of the accrued market discount right here and the wash sale. And then the resulting gain in this situation is $7,100. Now, why is that considered the default formula for calculating the gain? Let's do an example. So you go into the market and you buy a bond for $2,600 when it really has a face value or par value of $3,100. In other words, you received a $500 discount. That discount represents your interest income that you will earn by lending the bond issuer $2,600. In other words, just in case you're not following that, instead of you lending the bond issuer $3,100 and then having them pay you $500 in cash interest over the term of the investment, and then they give you back your original $3,100 at the end of the term, you simply loan them $2,600 up front, and then they give you back $3,100 at the end. And so either way, at the end, you're still sitting on $3,100 in your hand, of which $500 was income. The only difference is that you loaned less up front, and therefore your interest income is earned by receiving more at the end, versus this other setup where you loaned more up front, you got the same amount back at the end, and then your interest income was just paid along the way in cash. Now, the default tax treatment in that situation, in other words, buying a bond at a discount, is that you don't pick up the $500 in this example over time as taxable interest income. Instead, you wait until maturity or disposal of the bond, and then you pick up the full $500 of interest income all at once at the end. So let's go back to the default example calculation. What is incomplete about this? In other words, what is incomplete about this calculation that we did right here? And the answer is that we did not take into account where this $500 that we backed out of the capital gain calculation, where this $500 ended up going, and the place it ended up going was onto Schedule B for interest income. This is where I would expect to see your interest income, in this case $500, picked up at the end of that bond term. Okay, so it's not just that the $500 market discount is removed from the gain calculation and then just disappears. The market discount is reclassed, meaning it is moved from one place to another, and it is taken out of the capital gain calculation on Schedule D, and it is put into the ordinary income calculation on Schedule B. So as we can see right here, while the negative $500 is buried inside of this number right here as a reduction, it is then picked up over here on Schedule B as interest income. Now, the alternative to the default treatment is if you elect to pick up the accrued market discount, or interest income is really what it is, if you choose to pick that up over time, in other words, like in the previous years to when you disposed of the position. If you picked up the $500 of interest income over time, then you would get basis in your bond position for the income that you already recognized related to this position. To get basis means that you would add the amount of income that you picked up already to the cost basis of your position. So if we go down here on the original Schedule D, the $500 of market discount was in this column right here as a negative number, and then it was taken over to Schedule B and picked up as interest income in the same year. However, on this Schedule D over here, which represents what it would look like if you had made that election, the $500 accrued market discount is no longer in this adjustments column. It's also no longer on Schedule B for the current year. Why is it not on Schedule B for the current year? Because you picked up the interest income already over time. Let's assume for this example that you picked up the full $500 of interest income over a certain number of previous years, i.e. not this year. So therefore you get basis of $500. And you can see that right here. Originally the basis was $2,600. But we got $500 in basis for the income that we already recognized over time, and that's why the basis in the election example is $500 higher at $3,100. Now, some of you may be looking at this and saying, well, wait a minute, but the gain in either situation is the same. We have $7,100 of short-term capital gain right here. We also have $7,100 of short-term capital gain over here. The only difference is that in this example, we picked up $500 of interest income in the current year, but in this example, we picked up a grand total of $500 of interest income in previous years, whether it was 1, 2, 3, 4, 5 previous years, doesn't really matter. The point is that we picked up that interest income over time in earlier years. Okay, now let's see who the smarties are. Why might you want to make the election to recognize the interest income over time instead of recognizing it all at once at the end? In other words, instead of recognizing the $500 of interest income on Schedule B in the current year, we've already recognized that $500 of interest income over time in earlier years. We accelerated that interest income. Why would anybody want to do that? What would be the point of ever making an election like that? Well, to answer that question, think back to our extensive discussion of Roth IRA conversions on the channel. What is the high-level point of doing a Roth IRA conversion? Well, it's to shift income out of high-bracket RMD years and into lower bracket early retirement years. Okay, now apply the same concept here to this investment example in bonds. Let's just say it's a 5-year bond. And let's also add some zeros to the accrued discount. Let's say we're talking about $50,000 of accrued discount instead of $500. Now, based on all your other income and laying out all of your numbers inside of the personal tax planning template, you've determined that you're in the 12% bracket for the first 4 years of this 5-year bond investment period, but you're in the 24% bracket in year 5. Okay, so with that in mind, how much tax do you owe in total over the life of this investment on the $50,000 of interest income under the default scenario versus under the election scenario? Well, let's take a look at that answer right here. Under the election scenario, where you choose to recognize the interest income over time instead of waiting till the end, you chose to pick up 20% of the interest income each year, or $10,000 in year 1, year 2, year 3, year 4, and year 5. However, in year 1 through year 4, you're only in the 12% marginal tax bracket, and therefore the tax due on that $10,000 of interest income is $1,200 a year for the first 4 years, and you happen to be in the 24% marginal bracket in year 5, and therefore the tax specific to year 5 on that $10,000 is going to be $2,400. Therefore, the grand total tax that you paid on the $50,000 of interest income was $7,200. On the other hand, if you stick with the default method and defer the recognition of all the interest income to year 5 on this bond discount situation, then you're going to pick up the full $50,000 of interest income in this single year. It's going to be subject to the 24% marginal bracket because that's what we've determined you were going to be in that year. Therefore, the grand total tax paid on that $50,000 of income is $12,000. The difference right here between these two is about $5,000. So through the use of some simple tax planning, which I know many of you are doing already inside the personal tax planning template, you can save yourself $5,000 of tax right here in an example just like this by figuring out, number one, if you are invested in securities that have accrued market discount associated with them, and then number two, figuring out what tax brackets you are projected to be in over the next few years, which you're probably doing anyway for Roth IRA conversion purposes, and then putting those two pieces of information together to determine if you want to make this election and accelerate that income into potentially lower bracket years, thus keeping more money in your family's pocketbook and out of the hands of the government. By the way, in order to get everyone organized and ready to go for the 2026 tax season, my fully updated 2025 tax prep / 2026 tax planning information organizer is now ready and available for download. The tax organizer is available to all of my viewers and contains over 197 tax questions and related guidance to help you get all of your tax ducks in a row during the 2026 season. You can find a link to download the tax organizer in the description below this video on YouTube. In addition to that, my 2026 tax season prep and planning class launches February the 1st, 2026, and will be running through April the 15th, 2026. This 10-week-long intensive tax class will dive deep into the world of both tax preparation for 2025 and tax planning for 2026 and beyond. You can find a link to the video FAQs about the class at the link in the description below this video. So that's going to be it for today's video. Thanks everybody for watching, and I'll see you next time.